Good morning, Mr. Arjun Murti. Thank you very much for doing this.
Good morning. It's a pleasure to be here.
I really appreciate your time. I know it's valuable, but I know the audience will really appreciate your insights.
Thank you. Thank you so much.
For the listener, you are a board member at ConocoPhillips. You were an ex-partner at Goldman Sachs. You have a great Twitter feed, good Substack, advisor at Warburg Pincus. But how would you describe yourself nowadays?
I'd still say that sort of at my core, I'm an equity research analyst. And you referenced, I was at Goldman Sachs. The first 22 years of my career was sort of a very traditional, mostly sell side. I was on the buy side at JP Morgan. I started at a small investment bank in Denver, but sort of as a Wall Street equity analyst, covered the broad, mostly traditional energy sector, mostly US, but I did do the Canadian oil sands companies in particular. Loved covering Suncor, Cenovus, Canadian Natural, and so forth. To varying degrees, oversaw our globals team, became co-director of research, and then retired from Goldman in 2014. And for the last 9 years, have been in these various board and advisory roles at Conoco and Warburg and at Columbia Center on Global Energy Policy. And then early this year, I've actually unretired, as I like to say, to a company called Veriten. It's based in Houston. It's founded by Maynard Holt, who was known for Tudor Pickering Holt. He's the Holt of TPH. And it's a new firm that's focused on partnering with a number of companies and helping them think through strategy and how to navigate this sort of crazy energy world we find ourselves in. And it also has an energy transition fund. So I think we say research, strategy, and investing. And I've been, part of Veriten and still doing the various advisory board roles for the, I guess it's been 3 or 4 months now. So,
In summary, you're a very interesting person.
I don't know about that, but always happy to talk about energy, and I appreciate, again, the opportunity today.
Maybe we'll kind of break the conversation up into two halves, the banking side and maybe get into energy afterwards. Why invest in banking? Why did you choose that career?
And so I was a research analyst. I was on the research side of that. And I honestly had probably no idea what I really wanted to do in college, but I knew I liked markets. So I had a part-time job working for actually a stockbroker in Denver. And the actual stockbroker job, I knew I did not want to do, kind of cold calling retail investors, part of it. But I loved people sort of when they'd come on, it was Shearson Lehman Brothers talking about markets. And one of my most memorable moments was, I want to say it wasn't Jim Baker, but it was either Jim Baker or another gentleman meeting with, the Iraqi delegation just before the start of Gulf War I. And I remember him uttering the words, "I regret." And the market just dropped like 200 or 300 or 400 points, which was a lot in those days. And that was probably Dow points. And I remember just being hooked on the idea of sort of news flow, as it turns out, geopolitics, understanding companies and what it meant for the markets. And so ultimately got a job out of college. I went to college in Denver at Petrie Parkman, and really have loved the sort of research job, diving into companies, understanding macro geopolitics and markets. And, again, even though I've kind of became a director of research, I do this board work now, I still say at heart, I'm an equity research analyst. So
You ended up at one of the best investment banks, Goldman Sachs. Was that always the goal?
I would say there was never any purposeful path along the way. Again, I grew up on the East Coast in New Jersey, originally tried Cornell Engineering School, which was not for me, and ended up transferring to the University of Denver to get a finance degree. Even as I had good grades at Denver, and even as I was going through kind of my academic career there, and I loved school there, my parents had moved to Santa Barbara. And I thought, hey, that'd be great. I'd go live with them on the beach. I had no sort of purposeful career goals at the time, to be honest. And a professor of mine came to me and said, "Arjun, there's this firm looking for a junior research analyst. I'd like to submit your resume." And, that's how kind of it all got started. So I got a first job at a school at Petrie Parkman, and it kind of got me hooked. So I'd say the whole career has been pretty accidental. I think I've been pretty lucky on the way, ultimately going to JP Morgan. And then, as you just mentioned, to Goldman Sachs.
Do you have a favorite time at Goldman Sachs that was the most stimulating, most enjoyable?
Well, I always hate to say it's favorite because it was definitely tumultuous, but I think going through the financial crisis at Goldman Sachs, it was certainly the most memorable time. So just the pure chaos of that environment where you had this major energy bull market. And of course, my team and I, that's how we first kind of made our market Goldman. We had a call called the Super Spike call in 2004. And expecting a kind of a pretty big bull market in energy for some period of time. And it culminated in 2008 with oil ultimately reaching $147 a barrel. But of course, the flip side of that was a pretty terrible recession, a financial crisis, which might have been catalyzed by oil rising, but of course was more about housing and over leverage and all the challenges that the banking system faced. But I'd gotten into kind of I guess I was a business unit leader at the time, but a little bit of a management role. So helping Goldman sort of work through, okay, how do we restructure at least my area of the research department, which was the energy team? How do we still make calls? Those were days where even companies like Exxon, which was a very stable, low risk company, that still is, but was particularly so in those days, they were having massive 10% plus moves on a daily basis. Congress was rejecting TARP and accepting TARP, and it was just pure chaos. And it was very challenging at the time, but it is my most memorable time at Goldman. It's probably one of the times I'm most proudest of in terms of helping the firm manage through that, or at least my small role in that. And of course, the calls we made. And the calls we made weren't always right, but it was an exciting time to be on the street, even if it was actually pretty terrible to go through at the moment. So,
how did you end up specializing in energy at Goldman Sachs?
That goes back to that first job. So, I had a basic finance degree, didn't really know a lot about the energy sector beyond the Gulf War causing oil prices to temporarily rise before they then fell back again, but certainly knew nothing about the oil and gas sector. I remember in my first interview, the firm, this is Petrie Parkman, said they specialized in E&P. I had really no idea what they were talking about. And even when they said exploration and production, I still honestly never really knew what it meant. And then they explained, well, we have this company, Triton Energy, and they've discovered some oil in Colombia, and this could be a big oil field. So we're doing some research on it. And, I think it took me a while to really understand what the energy sector is about. I think I've been very fortunate to have been in this sector. And there was a time 7 years of my career where I had a chance to move into technology in some different spaces. This was in the late 90s at the height of the tech bubble. And I remember thinking, I've now been doing energy for 7 years. I kind of enjoy it. I like the geopolitics. I like the global nature. These are all important companies. It's an important industry. And even though it's not kind of hot and sexy as, say, tech is or some of these other sectors are, I thought I'd at least built up a base of knowledge and networks and so forth. And that's when Goldman came calling. So they came calling in 1999. And that was sort of cemented the idea of sort of sticking with energy during my career. The next inflection was sort of in the 2012 to 2014 timeframe. So this is after the super cycle. I'd become a director of research for Goldman Sachs in the Americas, so starting to move into a management job. And it was somewhere in there that I realized I don't want to help manage an integrated investment bank. I actually like energy, and I actually like being an equity research analyst. And so that's when I ended up retiring, and I now do this board and advisory work. But I would say I think I've been pretty lucky to have been involved with the energy sector and oil and gas specifically, but also some of the newer technologies. And it's all by accident, and it's been a blast. So,
did you have an investment style that you kind of lean towards? Were you a value guy or growth, or maybe a mix of all of the above?
Someone was just asking about this sort of value versus growth perspective, and it's probably in a nutshell all of the above, but with a skew. I will say a skew towards value, only if that means you have to do the work on returns on capital and profitability and balance sheet strength and cash flows. And I associate that with the value sector, even though it absolutely can and should apply to the growth sector. And so I think my example in the growth sector might be a company like Microsoft, which was a growth stock in the 80s and 90s, then became a value stock, and I think has become again a growth stock. And my comment in this debate we were having is, why, as a quote value investor, couldn't we actually say, hey, Microsoft, let's just say it's 2010, they're kind of in the doldrums from, living off their legacy business. They're going to turn back into a growth company due to cloud infrastructure. Let's just say we believe they're going to nail this sector and have very good profitability. Why can't we forecast that out? Why can't we forecast it out and say, this is the kind of sector that isn't subject to short-term cyclicality, and there might be a 10-year runway where they can have really good growth and really good profitability. So to me, that's where I'd say value should not just be about buying beaten up companies and beaten up sectors. There can be value to a company that is rapidly growing if they're going to generate profits and returns. Maybe it's dividends, maybe it's not down the road. And so I don't like the labels. I probably skew towards value, quote unquote, But I think what I mean is I don't like the pie in the sky, let's dream up some crazy growth scenario and then hope it works. And some of those things do work, a lot don't. Those are probably the kind of things that I find inherently less appealing. I will say within oil and gas, though, especially early in my career, I did like some of the exploration stories, and there's probably elements of quote growth in them. So Murphy, you can stop me anytime, but Murphy Oil was one of those stocks where they discovered Kikeh, the big oil field in Malaysia, and I got really excited about it. And that probably there wasn't a lot of growth and returns for some period of time. We made the call that within 5 or 7 years, that field would be very profitable. So that, I think there are elements of growth and value in everything, but I'd probably skew towards we should care about returns, we should care about cash flows, we should care about balance sheets, but that can apply to companies that actually grow. So
working at a top tier investment bank and all the excellent places you've been at, you meet a lot of interesting people and very successful investors besides yourself. Do you remember anyone that really stuck out to you in terms of the best investor or leader that you remember?
I think what I'd say is I've been very fortunate when I think of some of the best people have been actually some of the mentors I've had in my career. So that would be Paul Leibman at Petrie Parkman, who was Tom Petrie hired me, but he was my first boss, and he was an awesome analyst and really taught me the nuts and bolts and how to have discipline and how to expect high things of yourself and to not settle for, this report's good enough or this language is good enough, but to really strive for the goal of perfection. You don't achieve it, but the goal of sort of really nailing something. And then went on to JP Morgan, and there was an individual, Chris Karapi, who was just an outstanding investor and really thinking through long-term trends, how they impact both the short-term and the long-term. And he was really my mentor at JP Morgan. And then at Goldman Sachs, it was a gentleman by the name of Steve Strongen, who really founded Goldman's commodity research effort. It's now pretty well known under my very good friend and former partner and colleague, Jeff Curry, who I think most listeners will probably have heard of. But Steve Strongen and Jeff worked for him, started it. And Steve was one of the key mentors I had at Goldman Sachs. I say they all shared this sort of strive for excellence, discipline and process, not settling for just, hey, here's what everyone thinks, and we can be 2% different than that, really pushing yourself to the limit, really challenging conventional wisdom and conventional thinking, and not falling for lazy narratives. I'd say between Paul Leibman, Chris Karapi, and Steve Strongen, these are some of my favorite investors. They're all mentors. Probably most people might not have heard of any of them. Maybe Steve might have, people 10 years ago might have heard of, but they really have had the biggest impact on my life from a career standpoint.
What to you makes a good investor, and how do the best investors spend their days? Some people would say the best ones read all day and go for walks, but in your opinion, what makes a good investor and how do they spend their days?
I think it's going to vary greatly depending on the person. So it has to be what works for you. So I give an example that I know I'd be probably a pretty terrible venture capital investor, but that doesn't mean we don't need venture capital. We clearly need startup companies. We need the 1 in 100 bets to work out. And there's some excellent people in Palo Alto and elsewhere that do that. It's sort of not my style. I have probably gravitated now towards certainly some of the larger companies. That's just a little bit of nature of the career path that I took. I think everyone's got different styles and perspectives. I happen to be a big reader. I think you have to love what you do. And so to me, it's never been work. It's actually, frankly, always been a lot of fun. Maybe not every second of every day, but I think, the common theme is people have a passion for what they do. This may be true of any job or any industry. But I don't think there's an answer to what makes a great investor. I think it can vary greatly. So while I personally favor, and I mentioned it, let's look at returns on capital, let's look at profitability, let's look at cash flows, let's look at all these fundamental factors. Let's try and understand the management teams, what their motivations are. Do we trust them? Do we not trust them? What differential edge do they bring? Do they admit mistakes? These are all the things that I use. I talk to a lot of people. I follow a lot of publications. I try and get a spectrum of views. But again, I think different people have very different approaches. I do think for some people, momentum investing works. For some people, technical trading works. And I don't minimize or dismiss any of it. I think it's just going to depend on what you're comfortable with. So I think you have to do your own work. That may be the biggest common theme of all of this stuff. Do your own work. So
Warren Buffett is rumored to have trusted one investment banker at Goldman Sachs, and that guy was named Byron Trott. Did you ever cross paths with him, and what made him so successful?
I mean, I would say I know of him, Byron Trott, that is, than know him personally. And I will say, Warren Buffett has always been sort of one of my investor heroes. I think I've read all the books, especially when my career was in its earlier days or when I was in college. All those sort of Buffett books from the 90s, I gobbled them all up. And he is certainly, an investment hero of mine, and so forth. But, I don't know what it is that bonded their close friendship. I would imagine it's characteristics like trust, telling him what he wants to hear, not only what he wants to hear, but also maybe what he doesn't want to hear, being honest, being straightforward. These sort of common attributes of, can you build trust with people, and do they want to hear bad news? It's always easy to tell people good news, but when you tell them bad news or tell them there's an issue, how do they react to it? And I will suspect really strong relationships like might exist between Warren Buffett and the Goldman banker. I would assume it's based in those kind of foundational type attributes. So,
Lloyd Blankfein was the leader of Goldman Sachs while you were there. In your opinion, what made him so successful and such a good leader?
I loved Lloyd when he was the CEO of the firm, and got to know him a little bit. I was a research partner and their bigger divisions at Goldman and other people, but I did get to know him a little bit. And he guided us through some of the most challenging times at Goldman Sachs. And it's funny, one of the things, I mean, he said a lot of great things, but one of the meetings I remember is during the financial crisis, and we'd have these partner meetings. And he'd say, people would always come to him and say, what inning are we in? When is this going to end? When are things going to turn around and get better? And clearly that's something we would all want. No one wants to be mired in a big recession and a traumatic time, but he'd say, stop wishing away your futures. Go and execute today, live your life today. And he had this sort of in the moment aspect to it, which was both sort of philosophical, but also go generate a bunch of revenues for Goldman Sachs today. There's no question there was a business message in that as well, but stop wishing your lives away. Don't wish that if it's the second inning, that it's the ninth inning. You've then missed 7 innings. This is obviously a baseball analogy, but whatever you want to use. And so that sort of be there. I think he spoke in plain English to all of us. We always felt we were getting at least what he truly believed was the truth, or what was the best thing to do. It doesn't mean it wasn't polished or didn't come with sort of some amount of CEO speak, but I really loved having Lloyd as our CEO at the time, and I'm very fortunate to have been there during his tenure.
Energy. You are an American with an American perspective. You have dealings in Canada and various interests in Canada through companies. What is your perspective on Canadian energy as an American? Do you see lots of opportunity? Do you see risk? How do you think of it?
And thank you for the important caveats. And I think we're all, subject to our upbringings and our backgrounds and so forth. And I absolutely have a sort of American perspective to this. But as I mentioned, I've either directly covered or overseen the Canadian oils team. That probably dates back to the Goldman years. So let's just say since 1999 type time frame. And at various points, I was the direct analyst for especially the Canadian oil sands companies. And I've always thought they were generally misunderstood by American investors. And I'll say probably a few different ways. I think if you did word association with oil sands, people would say high cost, dirty, leverage to oil prices. And I think today, all three of those attributes, the leverage to oil prices is certainly true. I think the dirty moniker is really misleading and really lazy at this point in time. And I'm sure all of industry, and by the way, all industries used to be dirtier in every aspect. And that'd be true for a chemicals company, be true for an industrials company, and it was certainly true for oil and gas companies. I think all industries, but including the energy industry, but especially the oil sand industry, has taken huge steps to operate in a more environmentally friendly manner. I think this idea of profitability is very misunderstood. And so when you look at returns on capital and free cash flow from the leading oil sands companies, they are as competitive as any super major or other large independent. And in fact, the oil sands have been more profitable than U.S. shale. So now U.S. shale grew more rapidly. U.S. shale had the perception of being lower cost. And U.S. shale was scalable at a smaller level. So companies could fool themselves into thinking, hey, I'm generating good profitability at 50, and I can raise enough capital to drill the wells at $50 oil, even though, with hindsight, they did not work at $50 oil. Whereas an oil sands company, you can't do that, right? It's billions of dollars up front capital. You can't have pretend math that, oh, this is really low cost, so I'm just going to not include a whole bunch of capital and go forward with my oil sands. But you're always thinking on an integrated full cycle basis, where with shale, because the industry is disaggregated, because a different company drills the well, that completes the well, that then ships it on a midstream pipeline to a long distance pipeline to then refines it. There's so many different steps along the way. You can fool yourself into thinking this small little piece is low cost without taking into factor full cycle economics. And it's probably my biggest beef with investors and the perception of Canada. It is, I think, environmentally competitive with all other regions. B, once they do the carbon capture hub, and it's a big if, or it's not a big if, they have to make progress is what I would say. You're going to take away all your scope 1 emissions disadvantage. And I think we can hold them to account for that, but I don't see the environmental issue as applying to the oil sands specifically. And then on the profit metric, again, I actually love the 25, 30 years of sustainable free cash flow. So I'd say, I think there's a lot that's misunderstood about these companies. I think with natural gas, and this is true for oil, we always have this issue that it is overwhelmingly only sold to the United States. And for whatever reason, various ideologies or what have you say, no, we want to block pipelines. And I think it's really one of the most unfortunate developments of the last 10 or 20 years. So if I was giving free advice to the Canadian government, it would be figure out a way to get the provinces to get along and to push back on your own environmentalists to get the oil evacuated out west, presumably, so that it can get shipped directly to Asia. I think it's true for natural gas via LNG, and it's true for oil in the oil sands. And I know there's some infrastructure projects, I think it's Trans Mountain, that will come on at some point in time that will go west. But this idea of, how do you get the oil or gas out of Canada? That's always been the issue. And that's probably it's not a critique, it's a risk that I think it's a little bit up to Canada as a country and as individual provinces to solve that. But I've really enjoyed the Canadian oil and gas sector. I think it's actually very misunderstood in the US.
As the average Joe, my perspective on Canadian political policies towards energy is almost embarrassing from a Canadian perspective, but from someone like your perspective, do you view them as a risk, or how do you see them? Do you see opportunity in Canada, or is it just a big risky bet in some cases?
I actually think the risk reward is probably as favorable as it's ever been in my career in terms of having positive investment flows into Canada. And I think that's, again, it's especially true on the oil sands. And so it may be true that when you add up Canadian and US oil supply and then add up Canadian and US oil demand, you're kind of in balance today. Those numbers add up on a liquids basis to about 23 million barrels a day. And so someone can say, okay, well, we're kind of balanced. And yeah, there's some heavy and light mix shift stuff that you have to deal with. But why do we need more Canadian oil if we have enough for our collective use? This is a pushback that you get, say, from the environmental community. I would say Canadian oil, along with US oil, should be exported to the rest of the world. So if we're talking about a, quote, just transition, again, what about the other 7 billion people on Earth that on a per capita basis use a fraction of the oil that we do in the US, Canada, Western Europe, or Japan? And so I would say the best oil in the world should be and can be and will be Canadian and US oil. And so we should have more exports to the rest of the world. So when we say, is this a risky bet? Again, I think we're going to need this oil in a very meaningful way. When I look at the profitability pencils out as being very competitive with a whole bunch of other regions. When I look at things like carbon intensity and environmental concerns, I think there's a lot that the Canadian oil industry is doing to help alleviate and address those concerns. I think they're doing a better job, as best as I can tell, than, say, Russia's doing or some. No, listen, United Arab Emirates, I think, is doing a very good job. So there are countries in the Middle East that are doing a better job. I think they're doing a better job than the Permian Basin is doing, perhaps. There's some things they're doing in that country that I have a lot of respect for, that I'd like to see done in the United States shale plays, as an example. I'm most impressed with Pathways Alliance. There's still a long way to go on that project, but is one that can, down the road, help really take away the negativity on carbon intensity. So I feel like when we talk about risk factors, I actually think the cost of capital has been very high in Canada in terms of people not wanting to invest, not wanting to go into these projects. And then I look at the cash flow profiles and the profitability profiles of these companies. And it is not every company, but just to say some of the leading companies. And I think the risk reward is actually very favorable. The problem is trying to get investors to go up there is very hard right now. So you can do it as an individual, and that's fine. But how do you encourage industry and companies to do it, or larger pools of capital? I think that's still been a challenge. But for those that are invested there, these cycles are going to be volatile. They're going to be long-term in nature. But I think there's a lot to be optimistic about on Canadian oil. And I think gas is a little bit of a separate question. We certainly have a lot of gas in the US. And there again, I think, therefore, it's going to be more a question of, can Canada get its act together in terms of LNG exports? And I think it's the same challenge that exists for a lot of the US gas producers. What's your LNG export strategy, given how much gas we appear to have in the US and that you all have in Canada? I think the export part of that is going to be a big piece to whether you want to be invested. And I'm speaking sort of generically, there's always going to be individual companies that can be profitable without needing LNG. So
The US has a lot of opportunity. It's an incredible country with the most, I guess, oil production and everything else, but it's also a very efficient market. Do you sense maybe more of an inefficient market in Canada with more opportunities, or is that are they both very efficient markets?
I think they got different pros and cons in that respect. I think, yes, there's a lot of efficiency in U.S. markets. Canada at times can feel like, hey, there's kind of a handful of investment banks that sort of, maybe they get along. There's a handful of large players. It can feel like something not quite as over-the-top competitive as the U.S. can be, but that's probably unfair because there's certainly a lot of independents and junior producers, I think we'd call them, in Canada, and it's probably outside of the oil sands, more in conventional oil and natural gas and so forth. There's obviously a handful of really large pipeline companies that are hugely responsible for a big chunk of the infrastructure. So the risk rewards are a little different, but I think when you look at Canada, certainly as a place with a fiscal regime and rule of law and an opportunity set and an ability to add and attract acreage and to transact and to engage in M&A. I mean, there's very few regions anywhere in the world, by the way, including Europe, certainly, obviously, the Middle East, that are as favorable as Canada is, or the US for that matter. And so I think when we look at it on a global basis, like, it's not a close call on whether Canada is friendlier as an investment climate than, say, Brazil. Brazil is a country I spent a lot of time in. They've got a great amount of really exciting oil prospects, but you're going to have to deal with a singular government and a singular major oil company there. I think there's plenty of opportunity in Canada, and I think we should look at it as a place to invest on a global basis. It's a friendly country. It's an ally of the United States. We share the same values. I think it should be part of the solution.
You view the Canadian oil sands as the biggest opportunity, or perhaps LNG, or what do you see as the biggest opportunity in Canada?
I get most excited about the oil sands over LNG only because I think has a greater chance of actually happening in terms of there are existing plants, there are existing oil pipelines. I think that Pipeline West is going to get done, so there'll be some export options, and of course can also be railed out as well. I think that's a unfortunate worst case scenario that has to occasionally happen, rail and truck. We should have this stuff all go on pipelines. But either way, there's an ability to get that oil out. And so to me, I think, continued steady growth in the oil sands, and again, with the returns and cash flow and earnings profile that come with those companies, to me seems the most straightforward. I think with natural gas, again, it becomes a little trickier. And again, I'm speaking generically. There's going to be individual companies that this doesn't apply to, but where, the US doesn't really need the gas. So then you're kind of more dependent on exports. Now, there are places like the Montney and so forth where you get the liquids content out of it. And so, again, there's sort of some liquidy gas plays, if you will, that have some merit. And the Montney jumps out, I think, on that regards. But I think pure gas, it feels like you're gonna need to believe that Canada will want to export gas as LNG to be really excited about it. So it's probably a distant view. I'm sure you have other guests who will have more knowledge about the gas market. So
one of the critiques of the long life projects like the oil sands is that it's a return of capital, not a return on capital. When you're investing in big projects like that, how do you emphasize a return on capital? Is it dividends paid today? Is it the buybacks? Or how do you make sure investors get paid now?
Yeah, so I'm going to really disagree with that perspective. When I look at the long-term returns on capital from the oil sands companies over long periods of time, we're talking rolling 10-year periods, let's just call that. They are competitive with the leading companies in the world. Now, are there moments in time where you've just invested a bunch of money and the early years, it's the return of the year tails? And so, listen, if people don't want to invest in long life projects, they don't have to invest in oil sands. They can invest in to invest in these things. But to me, factually, kind of was originally for now it's a handful of companies. These only return of capital.
Oh, go ahead.
Maybe you could just redo the question and I'll answer it. So
Why the critique of the long-term projects is that they aren't a return on capital, they're a return of capital. So in your opinion, why is that inaccurate?
so this one I'm going to actually push back pretty hard on. And I'd say when I look at the oil sands projects specifically, over long periods of time, you have very competitive return on capital employed. Now, that's an accounting metric we use to evaluate companies, but these are double-digit to mid-teens returns on capital. So yes, when a project first starts up, you've spent billions of dollars over 5 or 7 years. The initial period of cash flows, that might be return of capital. But I'd say over long periods of time, when I look at the major Canadian oil sands producers and maybe some of the divisions of major oil companies that are in the oil sands, these projects have generated very competitive returns on capital employed that then feeds into dividends and stock buybacks. Now, the nature of it is different. Not everyone wants a long life project. So if you as an investor say, I don't want to wait 5 to 7 years for startup, and then the first 3 years of that, I'm getting my capital back. If you don't want that, there's no one's forcing anyone to invest in these projects. What I would say, though, is I think oftentimes investors are placing too high of a discount rate, too high of a cost of capital on these kind of companies versus what is very competitive return on capital employed, the free cash flow, the dividends you get from those kind of projects. And that's what I find appealing about them. That's not true all the time, but there are times it is true. And we may be in one of those times right now. And so again, they're different models of how you can invest. You can invest in a MLP or a pipeline company that gives you a year-to-year dividend. That's certainly fine. But I actually do not think the critique, I find the oil sands projects and companies have competitive profitability over long periods of time. And that's what gets me excited about them. And when they're out of favor, as they have been and as they sort of may be now, that to me is an opportunity, especially for people with a little bit of a longer term view. So
To get into the weeds a little bit, what is a good return of capital to you? Is it 10% annually, 15%, getting up to maybe 20% annually?
it's actually a great question. And so I'd say when you look back over the last 50 or 100 years, for industry overall, the return on capital is about 10%. Sometimes it's 8 or 9, maybe 10%. This is for the average company over long periods of time. It cycles up, it cycles down. I'm going to call 10% about a cost of capital return. Now, within that, you can quartile companies. So you got your best in class and your worst in class. The best in class companies generally can demonstrate a 15 to 25% return on capital. Now, who actually makes up that first quartile can vary a little bit over time. I will credit Exxon and its legacy predecessor companies and Royal Dutch Shell that between 1910 and 2010, they were generally always or most of the time in that top quartile of consistent high double-digit mid-teens or better returns on capital. It's fallen off over the last decade. They're trying to get it back, but there was a really long history of doing that. And that to me is what all companies, but especially the larger companies, are striving for. How do you put together a portfolio of projects and assets? And it's always going to have to evolve, where over time, all the ups and downs, you can earn at least a mid-teens or better return on capital. It's entirely possible, not for industry, but for the top quartile companies. And by the same token, if you're in the bottom quartile, you're earning 0 or less. Now, it could be an exploration company with a bunch of dry holes, but frankly, there are a lot of sort of very, maybe it's a company that said, hey, I'm really bullish on gas and oil, so I'm going to buy a bunch of high cost projects. And let's just say that doesn't out. Let's just say the environment does not turn out to be bullish. That might be why they have a 0% or 3% or 5% return on capital. There are lots of different reasons. Maybe the asset used to be good and then tailed off for whatever reason, maturity and so forth, or they made an acquisition in an area they didn't know anything about. There are lots of reasons for why returns on capital weaken or go down. But I'd say best in class, we're talking mid-teens or better. And I think that is what especially larger companies, but this can be true of smaller companies, should strive for.
In terms of cost of capital, if you go to the start of the Berkshire Hathaway reports, Warren Buffett will reference the S&P 500 for his, so to speak, scorecard. What's your cost of capital, or I guess hurdle rate that you apply to projects? Is there a number that you kind of look towards, or an index?
There's probably, I probably look at it differently. And this, especially as an equity analyst, there's this element of what are companies discounting. So it can be some version of what oil prices they're discounting, what return on capital are they discounting. It could be an element of how do they trade versus the S&P 500. I think as a company, you're trying to put in metrics that will allow you to be competitive with the best in class of the S&P. And again, that's going to be a mid-teens return on capital would be competitive with the S&P 500. For an energy company, it's probably going to mean a dividend growth rate of high single digits. Again, for larger companies we're talking about now, you're probably not going to compete with some companies on volume growth, as an example, nor would you want to. And so, there's different algorithms to kind of get you to what best in class in the S&P means, but it could be a high return on capital, give a big chunk of it back to shareholders, and through per share metrics and through dividends, you are competitive with the S&P. But again, for oil and gas companies, I think we're solving for some mixture of what are the stocks discounting, either in terms of what discount rate at the given oil price equilibrates the current stock price. So am I discounting a 15% cost of capital to get the current stock price to equal the that value based on some oil deck, or hey, the stocks are discounting $50 oil and the oil price is going to be 80. And I think there are many different ways to kind of try and triangulate this sort of cost of capital question. I would say for me personally, I don't think there's a specific metric that I would just say, this is what I always use. It's really going to vary by the nature of the company. But I think for larger companies, it's going to be looking at where they're trading versus the S&P and trying to understand what that is implicitly reflecting. And do I think it'll be better or worse than that, as an example? So
another critique of energy is that the capital discipline just hasn't been there over the last 10, 20 years. And that as an investor, I can earn a safe maybe 10% in the S&P 500, or I can double my money in a tech stock. What would your response be to that? If you pick the right energy names, you can earn that pretty safe rate of return, or how do you think of it that way?
Well, I think this question and the last question, the previous question, they all to some degree go together in the sense that is the opportunity or not in energy. So either returns were depressed the last decade, which is my personal view. And so people will say things like they're always undisciplined. Well, that's actually not true. They are sometimes undisciplined. The problem is the sometimes can last 10 or 15 years, which can feel like forever to a lot of people. So again, if you go back over 100 years, this sector averages a cost of capital return, which therefore, since the last decade was 0%, must include periods that were also 20 and 25%. And you go back and forth between these environments. The back and forth means over 10 or 15 years up, 10 or 15 years down. And I think we're coming off a period where people saw, and I say from 2011 to 2020, the return on capital, this is for oily companies. It's a little bit North America skewed, a lot of shale oils, but includes the Canadians, had a 0% return on capital. It's obviously a terrible number. That actually argues that for some period of time, we're going to do better than that. And in fact, in 2022, last year, the return on capital was over 20% for industry, and it was 27%, I think. And so I think we're in a period now where returns on capital will be mid-teens or better for actually industry. And I think for best in class, it's going to be 20% plus. Now, some of that will just naturally degrade over time as, say, shale inventory matures or something else happens. And that's why, whether it's M&A or new investment, all of that is always needed. And so I don't think industry can sustain a 15 to 20% return. It's going to be 10% over 100 years. But I think we're in a period of time where after low profitability is going to be better. But that's the call. And if someone says, no, that's not going to be the case, because I think oil and gas is going away because of net zero objectives. If that's your belief, then you shouldn't invest in the oil and gas sector. Again, I always say I'm not trying to convince someone of my view. I'm just trying to share my perspective. And I believe Oil demand will grow for the foreseeable future, but at least through the mid 2030s, maybe longer. I think natural gas, I can't put an end date on it. I think there's some uncertainty as to whether European gas demand might go away, and so you can get some choppiness along the way. But clearly, emerging Asia is going to be used in a lot of natural gas. And I actually think, and it's not the focus of this conversation, that coal is actually going to grow. It's now 90% in non-OECD fuel, and those countries all need massive amounts of energy, and a lot of them have a lot of coal that I think they will use up because it's going to be very competitive on a cost basis, and they have jobs and so forth. And so I think that's my view. And someone else can say, no, I think there's going to be really strict climate regulation and all this stuff's going away. And so I'm sure, well, then don't invest in the oil and gas sector. We're not trying to convince people of anything. But when I look at the lack of confidence in demand, and when I look at, as you pointed out, the lack of confidence in historic lack of capital discipline last decade, people are over-indexing what happened last decade on profits with what's going to happen in the future, in their view, negatively in demand. And they're coming up with this I don't need to bother scenario. And I think that is the opportunity today to say oil and gas demand will be better than people fear. And the profits were low, too low last decade. Capital's now fled the sector. No company is allowed to grow. And you're going to correct those returns on the upside with probably an extended period of much better profitability.
Oil and gas is a commodity, and the nature of commodities is that they're volatile. Would you advise or do you think it's possible to hold oil and gas names, or does the investor by definition need to be active?
Again, I think this goes back to also an earlier question where it's going to depend on one's investing and trading style. So I've never enjoyed the sort of rapid trading aspects of any sector, including oil and gas. And so my personal view is I use the phrasing super vol as the macro backdrop. So I expect we'll get to pinch points where you're out of spare capacity, you're out of inventories, price spikes up like we saw in June of 2022, and then you force demand back down to available supply. And that can be a very painful process. It can lead to economic, maybe not always recession, but at least slowdown. I think we've seen some of that, and you're going to go back and forth. And so someone may say, hey, I can trade that when, I'm going to be able to trade when oil's at 120 to get out of the stocks and when it's at 70 or 60 or 50. But again, is right now the low at 70, 75, or is it going to go to 40 or 50? Like, I think these things are always easy to identify and say, my personal view is people believe the sector is going away because of climate concerns. You can have climate concerns, but I don't think oil and gas demand is going away. And they think profitability is going to be below 10% when I think it might be above 20%. And that keeps me wanting to stay in the sector on a long-term basis and say, when I get to 2030, and I look back over the previous decade, I believe I will have been very happy to have been invested in the energy sector. But again, there are many different ways to do this. It could be, hey, here are a handful of management teams that we really trust and have confidence in, and they're going to play the very volatile, generally better than expected environment well. Or you could have someone who's a trader of this stuff and say, hey, I've got metrics on momentum and technical trading, and there are people who are going to want to do that. And I don't think there's an answer to what to do. My personal view is taking a longer-term approach and saying, over this decade, I expect profitability to be good. I expect demand to be much better than feared, and therefore I want to stay invested in the sector.
Recently, energy has been undervalued, which is an opportunity. But in your opinion, what is the best catalyst to bring investors back to the sector? Is it profits and shareholder returns, or what is the best catalyst?
There is no substitute for generating profits. Like, it is the greatest elixir out there. It is going to be irresistible to investors. You have to generate profits. Now, oil and gas is going to be volatile, so nothing I'm saying would suggest that it's going to be smooth profits. One of the metrics I look at is, let's look at oil prices versus returns on capital. I do a regression, and are you doing better or worse than the regression line? With the basic idea being that if you're kind of, quote, staying above the historic regression line, it's just a picture, I'm describing the picture I drew, you're still generating good profitability. Even if oil has gone from 100 to 70 or whatever the metrics are, you're not over-investing, you're not seeing erosion in your core asset base due to maturity or what have you. And so there are different ways to look at it. But as long as I feel comfortable that, hey, I think at $50 oil, companies would actually today earn like a 10% return on capital. That's much better than the zero or negative numbers most people were doing 10 or 15 years ago. And it won't last forever because inventory doesn't last forever. So you need to constantly take some risk. That's where I push back on investors and saying, you can say they wasted a bunch of money last decade, but that doesn't mean zero spending is the right answer going forward. And I do think that's where which management teams do I trust and have confidence in and have a demonstrated track record, or there's been some change at the company that going forward it might be a little bit better, whatever the reasons are. But again, I think yes, there'll be lots of volatility on the way, but I think the profits are just irresistible, and probably a lot of that does need to go back to investors, but not all of it.
Well, that's a great conversation. I know you're busy. We won't chat all day. Maybe just to bring it back to your career, you've had a very successful career. Opportunity knocks. Do you remember a time in your career where the doors seemed to open, and you remember a time when there was a crossroads and things really opened up for you?
I mean, I probably have had a few different crossroads. I'll say, I mean, there was the first job that I already described. I will say the move from the first job at Petrie to JP Morgan, the buy side, I'm from the East Coast. I wanted to come back to New York. I think then the opportunity to join Goldman Sachs after 7 years of doing energy and wanting to stay with energy rather than going to tech, I'm absolutely grateful that I made that sort of correct decision to do that. And then I guess I probably got lucky that we ended up having a major bull market in oil and gas, and our team contributed to having kind of a forward-looking call into that bull market, which definitely helped the career standpoint. The next crossroads was clearly sort of after I became director of research and kind of just saying, I really don't love this director of research thing. And I need to take a break. And my wife really convinced me to retire, that I was not really that happy, for the first time working a gazillion hours and so forth. And listen, I got to catch my children through middle school and high school at home. I have the board work and advisory work, so I wasn't doing nothing. I did play 100 rounds of golf a year, and I started at age 45. But so I was able to have a better, quote, work-life balance, but I got to see my children, which, you're younger than me. I'm in my mid-50s. Certainly people in their mid-50s or older, that is just not something men or husbands historically did, especially, my father's generation. And so I was one of the few stay-at-home dads. And at 45, most people aren't kind of, quote, retired at that age, certainly not on the East Coast. And so, but it was great. It's the best decision I ever made. And now the kids are going to college. We've got a new cycle upon us. And so I've decided to unretire, as I say, and join Veriten. And that's been also a great decision. So I think people can get into ruts. I think they can feel, I'm a partner at Goldman Sachs. I get an above average income from that. It's some stature is involved with that. And I don't want to lose that. And I don't feel like I lost anything. In fact, I got to join the board of ConocoPhillips. I'm very grateful for that, to become a senior advisor at Warburg Pincus, to have joined Columbia's Center on Global Energy Policy, and to understand and learn about the policy role, something I didn't know that much about. And now I'm an advisor also at ClearPath. Columbia is nonpartisan, but I will say skews towards moderate Democrats. ClearPath focuses on specifically Republican members of Congress and having a conservative energy and climate policy. And I love the balance of those two things, to kind of see the spectrum of sort of policy choices. And it helps me as an investor, and it helps me as an analyst. So, all these different crossroads that, I think people have to choose for themselves. And I know I've been very lucky and very fortunate, and really appreciate your inviting me on. And it's been a great pleasure to be on your podcast today.
Well, thank you. I really appreciate it. Maybe just to leave things, advice to a young entrepreneur business leader, what would you tell them?
There's a mixture of sort of following your passion while also being appreciative when you are in a good situation. And so this probably would be the advice maybe more to someone who works as a young person at a firm like Goldman Sachs, and it could be an equivalent major Canadian bank or oil and gas company or energy company, whatever it may be, and which is, if you're getting good mentoring and if you're getting good experience, oftentimes people make the mistake of leaving for, $5 greater compensation somewhere else, or, they get slighted that they didn't get some promotion that they thought they deserved, or what have you. People leave companies for a lot of dumb reasons at times. And I think, again, it is a terrific firm that you work for, and are you getting mentoring and training? And it doesn't mean everything's perfect every day. It never is. But there is sort of this not gutting it out to a degree. And there's not an answer. Sometimes you should leave if it's a toxic situation or what have you. But there is an element of gutting it out that I think is a little bit lost, maybe today versus what used to be the case, and sort of being appreciative for being in a great situation. And so follow your passion. I do think people should go into the office. I don't know how young people can work from home and expect to learn anything and benefit from all the stuff that happens on the side and to get mentoring or so forth. So go into the office and kind of decide what you want to do. I mean, if you don't want to work a gazillion hours, then don't. But then don't be surprised if the financial rewards or the other successes don't come with it. There's always these trade-offs. and I don't think there's any escaping them for the most part. So.
Well, thank you. I really appreciate your time. If anyone wants to find you, you're on Twitter and you also have a great Substack.
Thank you so much. Yeah, arjunmurti.substack.com. It is on the Veriten platform as well. That is all for free. Twitter's for free as well. And so I do feel this sort of, hey, I feel like energy is something I know something about. We're in these times where there's a lot of polarization. I think there's actually a lot of misinformation that comes from all sides. And so it doesn't mean I'm right, but I do believe I take a pragmatic approach to these things and hopefully provide a voice that is at least non-extremist if there's any goal in there. And people are always welcome to debate anything I say as well. So.
Well, thank you. We'll wrap it up there.